For much of the last decade, capital allocation inside U.S. companies followed a familiar pattern. When money was cheap and growth was rewarded, excess capital flowed toward expansion, acquisitions, aggressive hiring, and ambitious long-term bets. The assumption was simple: deploy capital quickly, capture market share, and worry about efficiency later. In 2026, that mindset has changed. U.S. companies are rethinking how, when, and why they allocate capital, and this shift is reshaping corporate strategy across industries. Capital allocation refers to how companies decide to use their financial resources. That includes decisions around investing in new projects, acquiring other businesses, buying back shares, paying down debt, holding cash, or returning money to shareholders. These choices signal priorities, and today, those signals look very different than they did just a few years ago. The most important driver of this change is the cost of capital. Higher interest rates have fundamentally altered the math behind many business decisions. Projects that once looked attractive under low borrowing costs now struggle to meet return thresholds. Debt is no longer cheap insurance. It is a real expense that must be justified carefully. As a result, companies are applying much stricter criteria before committing capital to new initiatives. This has led to a shift away from growth at all costs thinking. Expansion is no longer assumed to be positive simply because it increases revenue. Executives and boards are asking harder questions. Does this investment improve margins? Does it strengthen resilience? Does it generate predictable cash flow? If the answer is unclear, capital is increasingly withheld rather than deployed. One visible outcome is the rise of balance sheet protection as a priority. Many U.S. companies are choosing to hold more cash than they historically would have. This is not a sign of indecision. It is a response to uncertainty. Cash provides flexibility. It allows firms to weather downturns, respond to shocks, and act quickly when genuine opportunities arise. In a volatile environment, optionality has become more valuable than aggressive investment. Debt management has also moved higher on the agenda. Companies are paying closer attention to leverage ratios, refinancing timelines, and interest exposure. Instead of using debt to fuel expansion, many firms are allocating capital toward reducing obligations or restructuring liabilities. Lower leverage reduces risk and improves long-term stability, even if it slows short-term growth. Share buybacks are being reconsidered as well. For years, buybacks were a default use of excess capital, especially when growth opportunities were scarce. In 2026, buybacks are more selective. Companies are weighing whether returning capital to shareholders is more valuable than preserving liquidity or investing internally. The decision is increasingly tied to long-term confidence rather than short-term stock price support. Internal investment priorities have also shifted. Rather than funding bold, speculative projects, companies are directing capital toward core operations. Maintenance, modernization, and efficiency improvements are receiving more attention. Upgrading systems, improving supply chain resilience, strengthening cybersecurity, and reducing operational risk are now seen as legitimate uses of capital, not unglamorous expenses. Mergers and acquisitions reflect this new logic too. Deal activity has not disappeared, but it has become more targeted. Companies are less interested in transformational acquisitions that promise scale, but carry integration risk. Instead, they favor smaller strategic deals that strengthen existing capabilities or fill specific gaps. Capital is being allocated to clarity rather than ambition. AI investment highlights this change clearly. While companies continue to invest heavily in AI, they are doing so more cautiously. Capital is flowing toward use cases with measurable returns rather than experimental projects with uncertain payoff. AI is treated as infrastructure investment rather than a speculative bet. This discipline reflects a broader recalibration of capital deployment. Another important factor is investor pressure. Shareholders are no longer rewarding growth narratives without proof of profitability and cash generation. Earnings quality, margin stability, and disciplined spending matter more than headline expansion. Boards and executives are responding by aligning capital allocation with investor expectations for sustainability, rather than speed. Regulatory and geopolitical uncertainty also influence these decisions. Supply chain disruptions, trade tensions, and policy shifts have increased the risk associated with long-term capital commitments. Companies are factoring these risks into allocation decisions, often favoring reversible investments over irreversible ones. Capital that can be redeployed quickly is preferred over capital locked into rigid structures. This rethinking has changed how success is measured internally. Instead of evaluating leaders on how much capital they deploy, companies are focusing on how effectively capital performs. Return on invested capital, cash flow durability, and downside protection have gained prominence. Capital efficiency has become a leadership metric. Importantly, this shift does not mean U.S. companies have stopped investing. It means they are investing differently. Capital is being deployed with more patience, more scrutiny, and clearer expectations. The goal is not to avoid risk entirely, but to ensure that risk is intentional and compensated. There is also a cultural change taking place. For years, bold spending signaled confidence. Today, restraint signals competence. Executives who say no to marginal investments are often rewarded rather than criticized. This reflects a broader recognition that capital misallocation can destroy value faster than missed opportunities. In 2026, U.S. companies are treating capital as a scarce strategic resource rather than an abundant fuel. Decisions about where money goes are slower, more deliberate, and more conservative. But they are also more aligned with long-term value creation.